let's say that you're headed into retirement in a few years, or maybe you're already in retirement, and you've got some capital, and you're not sure if it makes sense to invest that capital or to go ahead and pay off debt with that money. Okay, now when I say debt, I'm talking about any kind of financing. I'm going to almost make an assumption that you don't have high interest debt if you're watching my channel. So we're not talking about, credit card balances that are used for buying clothes or whatever. We're talking about debt such as a mortgage, or maybe a small business, or a property, or some type of investment or asset that you've bought. So should you use that capital to pay off that debt, or should you invest that capital? That's what I'm going to talk about in this video. Now, I want to say that in general, being debt-free has been overrated, in my opinion, for the past 10 years. Everybody wants to promote being debt-free. I'm debt-free. People will email me or leave in the comments, I'm debt-free. Like that's the answer to the financial, problems or situations. And yes, there are a lot of bad things about debt. I've done a video on that, so please be sure to check that out, with the 5 bad things about having debt in retirement. And that's kind of a must-see if you are looking at this video, because I don't want to paint a picture that all debt is good. It's certainly not, and there's certainly some really bad things about debt. But the irony of this anti-debt movement over the past 10 years is that financing has been incredibly cheap. The interest rates have been so low. In the United States, you've been able to lock in mortgages under 3%, maybe 2 and 5/8 or 7/8%. That's unprecedented in my lifetime. And as you can see, I'm no youngster. I paid almost 10% when I purchased my first real estate, and when I purchased my first 2 cars, which, if you have heard me talk, I know I don't like debt on depreciating assets, but I was very young and I certainly didn't have the money to buy those cars without financing. So I financed at what was then the prevailing interest rate, and it was right around 10%. So it's very important, though, to note that after I financed those cars, or just before I financed those cars, the years before, the prime interest rate had been over 21%. So the 10% looked pretty good at that time. So it's all relative to where we are now. And I think with any investing, with any finances, certainly retirement finances or anything, it's really good to have that broader perspective of where are we now, where might we be headed, and where are we relative to historical levels of anything that we're looking at with our finances. So in this video, I'm going to share good things about having debt when you go into retirement. And I can almost guarantee you I'm going to get some thumbs down on this video, as I do on a lot of my content, because what I've learned is different from what most people believe and see and or promote. So that's all right. You know that I don't say things to make it easy. I say what I think the truth is and what I've learned to be the truth based on my own experience, which is always changing. Okay, so the first thing I want to say is that cash can be used for wealth building, and this is a good thing about debt in retirement, or even at other times in life as you head into retirement. So an example of this might be to use money to make a down payment or an outright purchase of an asset that has a very high probability, that's hard to say, probability, one of my favorite investing words, an asset that has a very high probability of increasing in price while we own it. So that can be a good use of debt. The next good thing about debt is that it can be used to purchase assets to generate income. Now, let me explain that I'm kind of talking about here using capital instead of paying off debt, doing something else with it. Okay, so in this example, maybe you would invest in dividend stocks instead of paying off debt. Now, dividends produce so little income relative to the amount of the cash that's required. It's so little that it may make sense to purchase another income generating asset that I've talked about in other videos. I commonly talk about how capital intensive dividends are. Someone may, for example, finance a nicer car to drive Uber and generate an extra income stream. Or someone may use debt to buy a small business, for example, that pays the bills in retirement. So the capital can be used for an income generating asset rather than for paying down debt. And debt can also be used at times for buying an asset that has a high probability of increasing in value and or generating steady or consistent income in retirement. Another good thing about debt is that most people don't have the cash to strategically purchase investment assets that can be used to increase wealth or to generate income, and therefore debt it's needed for such a purchase. The key with this is to be smart when buying assets, and remember the money is made on the purchase side. So you want to buy right. You want to buy an asset that is likely to increase in value, or the deal is structured so that it generates income. And it has to make sense. And if you're unsure how to evaluate this, you can hire someone. A good person to hire to talk this over might be a CPA that has expertise in this area. You could also use a financial planner, although financial planners lean toward more traditional assets and very traditional mainstream investing. So they are probably going to want you to invest the assets in stocks and bonds in a traditional portfolio, while a CPA may just be able to analyze the deal. There are also small business strategists that can help analyze this type of thing. If debt's been used to buy investment assets like real estate, and the financials still make sense as you head into retirement or during retirement, then that debt can continue to be used in a way to continue to build wealth or generate income throughout retirement. I don't see retirement as being this time when you cease your wealth building endeavors. I see it as a time when you become more strategic and you continue to accumulate wealth, because I just don't see that there's this cutoff of giving up on that the day that you retire. The next good thing about debt is it can be used to maintain or establish a larger emergency fund instead of paying off debt. So some people will take their emergency fund and pay off debt, and that debt may even be under 3%. I don't think that necessarily makes sense. So when all available cash has been used to pay off debt and there's no emergency fund, then a financial crisis can result. And that's what we really want to avoid. That's what we're doing all this investing and all this financial management for, is to avoid running out of money, not being able to pay our bills. So an emergency fund is super important, and I think that using money for that versus paying off low interest debt or sensible debt makes a lot of sense. Now, I'm not talking about the extremes where you really should, sell your house and pay off your debt and lower your standard of living. I'm talking about you've made some wise choices and you're sitting in a good situation where you can either use your capital to pay off debt or establish or increase your emergency fund when it isn't quite what it should be. Then I think it can make sense to just go ahead and increase that emergency fund rather than paying off low interest debt in particular. The great thing about this is that an emergency fund can be earning over 5% now as of this recording if it's stashed in a money market with almost no risk. So I always add that little almost no risk because everything has risk, as we know, even money in money markets. Okay, the next good thing about debt is that this one's a little more complex, but it's not. Money can be made on the spread between the cost of debt and the amount that can be earned on that capital when it's invested wisely, when it's used for investing rather than paying off debt. So this can occur especially when borrowers have low interest rates locked in on their debt. Let me give you an example. So maybe if you have 2.75% locked in on a mortgage, and you can use that capital and earn a 6% yield on your money if you invest it, then that could make sense. Debt could be good at that time in that way, when used in that way. So the next factor I'm going to mention, though, can make this even more beneficial, and that's that debt frequently has tax benefits. As crazy as it sounds, The tax law is written in a way that favors debt. It favors financing. It's said the reason for this is to promote economic growth. I have to wonder if the financial institutions might benefit the most from this, but I'm not going down that rabbit hole. Remember, tax rules change often. So before you go out and buy a piece of real estate because you're going to get tax benefits from having that debt or that loan, make sure you do some research and or talk with a CPA. Okay, the next good thing about debt is the value of locked in low interest financing increases when interest rates rise, okay? And let me just tell you sort of an example to kind of make that make sense. Imagine being a lender and you've loaned money on a house purchase or refinance at 2.75% interest at a time when rates have risen to 5% or higher. Who's at the benefit? Who's at the advantage? The borrower who has access to funds at 2.75%, or the lender who has loaned at interest rates that are lower than current interest rates. So it's sort of like thinking like a banker. It's thinking strategically, and like everything I say here, the same rules don't always apply. It depends on what's happening with interest rates, what's happening with the economic environment, what's happening with the financial markets. The key to debt is to use it smartly, and not doing so is where so many people get into trouble with debt, and that ends up giving all debt a bad reputation, really, even when it's used wisely. People hate debt, and I'm just not sure that that's always warranted. Now, I do want to mention that it's super important you're not in a situation where you have debt and that debt can rise on you, or it's not really on you, that debt can rise while you're paying it off. And in the United States, we can lock in mortgages 30 years, no problem. But a lot of countries, most countries, as I understand it, don't have that, and that interest rate can rise during that time frame. In that case, I really believe that almost all debt is bad. You have to be just so incredibly careful because things change, and paying that higher interest changes the situation. It changes your financial situation. So I feel like I have to mention that in closing in this video. And remember, retire certain.